Hello everybody, Jackson here at the Wealth Squad. Today we'll be talking about diversification and if it's necessary in investing. So right now we're looking at Berkshire Hathaway stock, the stock that Warren Buffett operates under, right? That's his company. He manages the portfolio, he's known for doing that. Maybe he's kind of doing a little less these days because he is pretty dang old, but he started out and grew it to the size it became top 10 companies by market cap, right? And we're looking at the performance of the last year, and it's actually incredible because growth has taken a huge hit recently, right? And we're looking at Berkshire Hathaway, one of the biggest value stocks, up 37%. Looking at Shopify, we can see down a little bit over the year. Adobe down a little bit, or not, it's up a little bit, but let's actually see, up 12%. Square, you could already tell. And basically, PayPal, same thing. Like all these growth stocks have been crushed lately, but Berkshire Hathaway, the biggest growth stock out there, doing amazing the last couple of weeks. You can see just within the last month, up 11% compared to the S&P 500, which is flat, right? So that's the separation between tech and, the value type of stocks and the general market. But over the last year, you can see that just within the last weeks, the separation has gotten even wider. S&P 500 grew 23%. Berkshire grew 37%. Over the past 5 years, you can see that the S&P 500 has outperformed Berkshire, not by too much, 105 compared to 96. But what we want to look at is let's bring the growth stocks in here, right? Because we're just comparing the general market to value. Bringing growth, and growth is outperforming both of those by a significant large margin. However, within the last month, right, we're seeing tech get crushed, down 5%. The general market flat, value up 11%. 3 months, value still outperforming. Now, what you want to ask yourself is how much money are you comfortable losing? And let's say you have 10 consecutive days of losing money, right? Your positions are going down. The majority of them are, negative. Can you still, think straight? Can you still invest based on numbers and not emotion, or, sell at a loss? That's what you have to ask yourself, because anyone investing in tech or, stocks like Upstart, for example, which we shouldn't even be comparing to those other stocks, but you can see Upstart since October down 71%, which is a huge drop, right? Down 70%. The company is now a third, a little less than a third of what it was in October. Anyone who's investing would lose their minds, right? Because that's a huge cut in such a short amount of time. But let's say you're invested in many different things, right? Upstart, for example, Shopify, also pretty dang hurt. Then we're looking at Berkshire, right? Now you're doing better. Aflac, now you're doing better. Pepsi, now you're doing better. Other stocks like Bank of America, now you're doing good, right? PNC Bank, now you're doing good, and now you're back to flat, right? Even after those giant drop-offs in the stocks. Now, of course, it depends on your portion sizing, right? Your allocation, because you can't have 90% Upstart and 10% or 1% each of these stocks, and you could still lose money, obviously. You have to be smart with it. You don't want too much value, because value is generally slower. right? Looking at PNC, for example, the last 5 years, up 88% compared to Apple, and it's not even, the same type of game. And Apple's one of the leading growth stocks, one of the leading, um, investments in Berkshire. Yet Berkshire is outperforming Apple within the last year. So let's get PNC out of here, Berkshire, and you can see Berkshire is outperforming just by a little bit, which is crazy because Berkshire is mostly value and Apple, right? And Apple's just Apple. So you can see that value does have its advantage in markets. So is diversification necessary? No, it depends on your risk tolerance, right? Are you willing to lose $100 based on your $100 investment? Maybe not. Are you willing to lose 50? Maybe not. Maybe you're willing to lose 20 or 30. Then value is right for you. You got to have more than just a couple of investments if you want to be smart about your money, right? If you have 5 investments and they each go down 20%, you're down 20%. But if you have 5 investments, or maybe 7, 5 go down 20% and 2 go up 20%, now you're not losing 20%, right? You're losing a little less. It's all based on allocation and your risk tolerance. And is diversification, necessary, is just a personal question. It shouldn't be for everyone because a 20-year-old knowing tech profusely, and crypto, and they're in that space, then they should be investing in that stuff. But a 6-year-old who doesn't know anything about tech or crypto should not go YOLO into some random crypto, right? They should be smart about their money based on their risk, their age, which is, based on their age and their preference, as well as what they know. So I hope this video helps. Is you answer that question, is diversification necessary? It is not. It's based on what you desire, right? That's all it is. So I hope this video helped. Thanks for watching.